In this video, I'm going to give you 3 UK stocks to buy in September 2021. And today I've taken a little bit of a different approach. Instead, I've opted to use a stock screener. The idea here is that by using the stock screener, perhaps we would find more stocks that I might not have found otherwise. This is great for myself because this means I get to search a little bit differently, try different new factors and see what I can find. And also for you, as hopefully there's a few new names that you might not have heard of. And if you like the video, please share one of these to help beat that YouTube algorithm. You may also know the camera angle is different. I have taken inspiration from another financial and investing YouTuber, JKR Investing or Jacob, and his idea where he screen records the computer and then has an overlay with himself on it is something I would like to try, because when I do these videos, typically these are the most stressful videos of the month because you have to find these stocks, find a good case for them, and then edit it all together, and it really did stress me out. So hopefully this is another way to save time. But without further ado, I've got 2 stocks today that I've never mentioned before on the channel. In fact, I've only discovered them within the last hour, but I do like their prospects. And then there's also 1 stock that I have been buying this month, and then I think it all wraps it together. But to start with the stock, we have, and I believe it is Boku. Boku is a stock that provides mobile billing and payment solutions for mobile network operators and merchants. This is a stock that is quite interesting to me because I think this is an area of growth for the future, as everyone seems to be using a mobile phone at the moment. Obviously you do have I'm playing devil's advocate here, you do have some people that clearly don't use mobile phones, they don't like technology, and that's completely understandable, but I see them as a mainstream adaptation, or at least evolution of society. A lot more of us are in fact using mobile devices. And when we look at the share price in the last year, we can see that it has had quite a steady increase. And a lot of people right now would look at me and go, well, if it's increased by such a dramatic amount in the last year, how could we really invest in it? It's not going to keep going up. And I understand that fear with some people. In the last 5 years, it has been a bit more trending, and I believe that relates to their earnings. But when we look at their valuation, we can actually see that they are on a negative price to earnings ratio. This is because the company is currently unprofitable, making the most speculative stock on the list. But I do have some justifications for this. So what we look at is the price to book ratio, which is their value based on their assets on the book. And what we have is a 10.7 times ratio, which is certainly on the more premium side. So when looking at this stock, perhaps being patient in investing could be a wise move, because we don't know whether this is at a high price relative to the company unless we do further technical analysis, and that's not something I particularly do. But when we look at the past performance, we can see that on the chart, things are quite impressive, namely the revenue growth. This is the blue line that you should see on your screen. This blue line has consistently increased since about 2017, and it has been very impressive at that. We can also see that they did actually reach profitability at one point, and that consistently over this time period, their free cash flow, the pink line, has started to become more positive to a point now where it is extremely positive. You can have a company that has positive free cash flow but negative earnings, and this is good for the company. Well, obviously it'd be better if they had positive earnings too, but this means that they're able to continue surviving based on their operations, and this is a good sign to see. In fact, when I look for stocks that I think have growth potential, I like to look at those companies that perhaps if they are unprofitable to have a positive and growing free cash flow, and this would tick my box for this stock. Furthermore, when we look at the health of the balance sheet and what they really have behind them, I think it's quite impressive. At a short glance, you can see that their short-term assets and liabilities are about even. But when we look actually at the debt to equity ratio, we can see that it's only 17.1%. They have such a high level of cash on the balance sheet of $62 million. I think this is very impressive, although perhaps the debt has risen in the last year, and that could be some cause for concern. But I think overall this is a good quality balance sheet. Although interestingly, perhaps their ownership of the company has been decreasing, at least from insiders, and we can see that there has been quite heavy insider selling in the past 3 months, although this could literally be just a person that on the board that just wants to sell part of their holding. And I think that's the case in truth, as it was only 195,000 shares, which is roughly £400,000. They're likely trying to cash out the company, try and make use of that cash. And then what I do really like about this is that the general public does hold 22% of the company, but it is heavily owned by institutions, and then the individual insiders still have 5.8% of the company, which I think is quite nice to see, as it does show some skin in the game. And with a market cap of only £578 million, I do think there is a lot of promise for this company in the longer term future. Although at the moment, judging whether it is a good time to buy now, maybe one that might be difficult to tell, but they haven't really had any substantial pullbacks in the last year. However, what we do need to look for with a company like this, it does seem that there could be a high spread, as there may be low liquidity. So do keep an eye on that one and do be careful. Make sure you do your research before this and see how much it could be. And if you'd like to sign up to my stockbroker Freetrade, you can actually get a free share worth up to £200 when you sign up using my link in the description down below. And I believe until the end of August, which by the time you're watching this, it may already be over, you can get a free share at a minimum of £10 each. So if you're thinking you want to get started in investing, I think that's a great way to start, because at least then you have a share that could be anything at random. And then the next stock on the list is one I've mentioned a lot on the channel, and this is Boohoo. Boohoo is the second most bullish stock I have in my portfolio, and the fundamentals are here very much to back it. Yes, I mentioned it in last month's stocks to buy. Yes, they do have some ethical, social, and particularly governance concerns due to the whole idea of capitalizing on slave labor by underpaying people or factory workers that are related to their suppliers. However, I think they've undertaken pretty much every step and measure to improve their business model relating to their suppliers and improving the overall supply chain. In fact, leading the UK towards a more sustainable path in this element, and I think this is something that's very promising. The share price has been relatively stagnant over this time, not really up much for the year, if at all, and I think that is great because it means that at the moment, whilst they're continually growing their financials, that it could be a cracking time to build up the position, and even myself, I'm buying this stock. What I really like about Boohoo is not really their valuation, right? Yes, it is certainly trading at more of a premium. Their price to earnings ratio is certainly higher than a more closer competitor, ASOS. But then that's to be expected when they do grow by such a fast amount each year. What I am interested in is the past performance. Their historical annual earnings growth in the last 5 years, a compound annual growth rate of this is 34.2%. That is impressive growth. That means roughly each year they're growing by that amount, and that's just their earnings. Their revenue has grown by a far faster pace during that time period, which yes could be a bad sign in terms of earnings not quite scaling with revenue, but it is still a great thing to see that this company is growing at such an incredible rate. And what I do like to see is that over this time, the profit margins have been relatively consistent. Sure, they have dropped down a bit in recent years, but they are also investing more of this earnings power back into other things, and obviously in these acquisitions of these businesses that Arcadia, when they had fallen, I do think that this means that a lot of their earnings that are going into that they're not going to be generating as much profits just yet. And you also can see that they've got quite strong returns on equity and very strong returns on capital employed, which is improving over the last few years. In terms of financial health, Boohoo has a fantastic balance sheet. This is a company you're not going to see with debt at all. In fact, they have none. And what we can see is that there is rising levels of cash. Although you might say, well, in the last year, it's dropped a bit, and that's due to their acquisitions. This is showing me that despite having so much cash on their balance sheet and making critical acquisitions in the sector, that they still have plenty of cash to spare. And in fact, it's going to get to a point where they may struggle to make use of it. Although lately they did announce their plan to improve their systems in the UK by creating 5,000 new jobs and investing £500 million in the UK to hopefully meet the growing demand, which is a great sign to see. And this is something I love, because meeting growing demand is such a statement. It means that even though they're investing this money, they're struggling to keep up with how much money they're making. I love it. It's a great sign. Obviously, this stock doesn't pay a dividend, but the management and ownership is something I do want to talk about. So insiders have just been consistently buying over the last 12 months. Not something I'm too interested in, but the insider ratio is something I do like. Individual insiders hold 20.2% of the business, and that is a great sign. This is showing significant skin in the game, with the chairman himself holding 12.78%, or roughly £441 million worth. And then we also do have institutions holding around about 43.7%, split with the general public, and that is good for me. As I said, I think this is a company that's going to do well. This is e-commerce. This is an area that has got a lot of growth in the future, and Boohoo are one that are pushing a lot of sales, and I think that they will definitely dominate because they are ones with greater margins and greater sales capacity than I believe other competitors, especially in the UK, that I think they're going to dominate and continue to grow to a point where they become a global industry leader. And then at that point, I think they're going to diversify outwards, like they did acquire Debenhams, which does have their beauty sector. I think they're going to use this beauty sector to their advantage and then cross-promote with their other platforms and brands, and then use these and develop outwards. So what I mean by this is that the beauty sector they have in Debenhams, if this does well, sells well, they could then transition this and start creating their own beauty products for Pretty Little Thing, another one of their brands, and then this could suddenly push out and out and out until they then have two very well developed sectors, or industries, sorry, and then they can keep doing this by making more strategic acquisitions. This is a stock I hold something around 3,100 shares of, and it is the largest stock in my portfolio, hence the real critical mention in this update. And then the other stock on the list is one that I do like the look of. And in fact, I hold a stock that's quite similar to this in my portfolio, although it is the smallest position and one that I've changed my thoughts on as of late. But I've always liked the idea of the industry. This is Speedy Hire PLC. What they do is they provide tools, equipment, and plant hire services to construction, infrastructure, and industrial markets in the UK and Ireland. This is something I like. I like companies that are providing the tools to do this. It's like with the whole gold mining process you had, and I'm really ad-libbing here, I'm going off what I remember. You had the whole people that were going and mining in the gold rush, who were trying to get as much gold as possible, but then you had the people that made a fortune by selling the pickaxes to those that were trying to get gold. Hence why I think this is a great industry to be in, although it's one that I certainly do lack understanding in. I do like this company. Their valuation, I think, is quite high. In fact, it's very high, but that's because their profit margins have certainly decreased. Their earnings have decreased in the last year and a half due to the likes of the pandemic and the after effects. And I think that's completely understandable. In fact, the same happened with my holding Ashtead Group, although Ashtead Group are a much larger beast, and so they were able to show agility in this sector. But then Ashtead Group is a £20 billion company. When we go more to a price to book ratio, it does show that they are perhaps somewhat undervalued. And then we look at their past performance, and this is something I do like. What we can see is that despite the revenue drop, their free cash flow has remained consistent. We can also see that yes, they were slightly unprofitable at the end of 2020, but that's okay because they've shown that they are actually pushing back into profitability. Even though before they weren't really the most profitable of companies, there's certainly potential here to really recover. And I think this is more of a play on the UK's construction and infrastructure in Ireland and how much they invest into this. And so if there is big investments into infrastructure, for instance, I think Speedy Hire will benefit from it. So I suppose it's a domestic investment into the UK, perhaps a good way to get exposure if you believe that projects will be announced and that Speedy Hire would benefit secondhand through selling more tools and equipment. I do also like the financial health of the company. They do have a very, well, I would have said an interesting, maybe even weak balance sheet a few years ago. However, what we can see is this balance sheet is significantly improving. We can see that over time they've been building a little bit more cash, and they've also been reducing the level of debt. Yes, their equity has consistently increased, that's great. But the fact that their debt has been significantly decreasing since the start of 2020 from 48.9% debt to equity ratio to now at 20.7%, I think the quality of this company is certainly improving. This could continue to drop. I've not really looked into what the board wants to do with this, but certainly this could drop down to zero, and this would be a high quality investment if they can continue to build cash. But then do remember that their earnings obviously are at the moment on the lower side, and so one questionable thing about this is their dividend. They do still pay a dividend as far as I'm aware, and it currently yields 2.06%. Their stability of this dividend is a bit questionable, but then it's understandable that they did cut it in 2020. I'm more or less concerned that they are perhaps paying it now in 2021, but then again, I suppose it's a choice, and the investors in this stock are likely in it for the dividend. I think that it is a little bit on the higher side, as according to the payout ratio, it is 348%, which would mean it's well over their current earnings amount, but then they would have the cash on the balance sheet to pay it. I'm not really a fan of that, but I do think there is some interest here, and I do think there is some potential with this investment. It's certainly one to watch and keep an eye on. Again, it could be a difficult one to time the entry with. Perhaps it's currently highly valued, but then if you look at the share price in the last year, it has been pretty stagnant other than from a significant boost when the executives changed in November. And then when we look at ownership of the company, this is heavily held by institutions, 92.1%. Individual insiders don't really hold much, but it could be a promising sign. But this does mean that because it's so heavily held by institutions, that the share price could be quite illiquid. So do be careful if you're trying to make large lump sum investments into this stock, and try to maneuver using this, or if you do buy this, by using limit orders. Hopefully then it restricts how much it pays. And I think being patient with an investment like this would be very much key. And if you'd like to see how well my 10 UK stocks that I suggested to buy at the start of 2021 have performed so far, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic day.